All right, guys, give me a quick sound check, screen check. Both are good. All right. So we're into May, and the markets are going from one story to another. What's hot today? Those watching it on recording, this probably will be irrelevant. Those here live, 1 o'clock in a couple hours Central Time, Trump gives his decision on whether or not he's going to keep the Iran deal. Now, the latest breadcrumbs, like I've been telling trading room guys throughout the morning, is some stuff could get baked in before he actually gives his decision, so it won't be a big surprise. First off, it was probable he was going to pull out. Then 11 minutes after 10 Central, there was press speculation that he was going to stay in it, but increase some sanctions onto Iran. The latest came out about 20 minutes ago, reportedly told France President Macron that the U.S. will withdraw from the Iran deal. That's a New York Times source. So now we're getting breadcrumbs coming out on both sides of what's going to happen. And that's not a surprise. That's should be how things happen. That's why you could see how this market has taken on a lot of different directions. Take a look at crude oil real quickly on a 60-minute. Here's what it did. The 60-minute isn't as good. 12 PNF. Here's what it did when it seemed like they were going to stay in it. It dipped into the $67 handle, and here's what it did when the New York Times report came out 38 minutes after 10 Central. So that's why it's important to stay on, keep your head on a swivel. Hold on a second. All right, I'm back. So that's kind of an update for the week, especially for today. It's it's kind of funny here because oil is going to be easier to read. So a comment like the last one was easily bullish for crude. The one at 11 minutes after 10 Central was easily bearish. Oh, he's going to stay in the accord. Oil could go down because there won't be a glut or there won't be a shock to supply. Oh, he's going to pull out. He told Macaroni that he's going to pull out of the accord. Oh, there's going to be a supply shock. Iran's not going to be able to sell their oil. Less supply, higher prices, oil goes up. For stocks, certainty would be bullish, and that is stay in the Iran deal, keep everything the same. Uncertainty because of the volatility of oil and what's next. What does Iran do? By pulling out of this agreement, creates some weakness. That's why we rallied. Pretty much we had to break with oil, but then we rallied quickly out of the hole from 62, 63, all the way up to 74. And that's why we're back to the scene of the crime, because the story has changed. So what's priced in right now before his 1 o'clock speech? So if he was talking right now, what's priced in, he's going to pull out of the agreement based on the latest headline. Now, that could change. New York Times could say it was an unreliable source. Or the White House could say, no, he didn't talk to Macaroni in France. So that's the, and I know it's Macron, but we'll make an Italian out of him. Something might come out of Macaroni's office, and he says, hey, listen, I didn't talk to President Trump about this. And we're right back to the 11 minutes after 10. So that's why these meetings on a weekly basis are important, and that's why the trading room day to day is important, because you can make or break your week, your month, your year, your quarter by catching or staying out of the hell out of the way of a big move. All right. So let's get to this week's content. It's kind of twofold, and I'm not going to keep this for an hour, maybe 30 minutes. But if you looked at my original slide, and that is, where is it? Here it is. Why isn't it going? The bottom line, and here's now you see it, now you don't. All right. Again, this isn't new concepts. I always look and find better ways to see the same thing. And you guys know that have been around a while. You guys have found better ways to see the same thing. The point is the key is what's the same thing, right? What is the important concepts and techniques? When you go through this program, it's spelled out: correlations, which is market relationships, and order flow, which is trying to track buyers and sellers, whether they're big buyers and sellers, whether they're quick buyers and sellers, whether it's a delta imbalance, whether it's a delta spike, or whatever. There's several ways to look at the same thing, and sometimes for certain people there are better ways, okay? But it all comes back down to one of those two things: order flow, market relationships. If you go through every coaching session in track 4, it's going to all the title or whatever is going to come back to one of those two. Aside from psychology, there'll be sessions on psychology. I thought Merritt's event last week was good, whether it was just to reinforce or tell you, hey, if you're not preparing efficiently, then you're not preparing. If you're spending hours trying to prepare, you're over preparing. If you think you're going to wake up all groggy and trade with 2 minutes of prep, that ain't going to work either. But let's get to today's content, because I want to get back. These markets are moving pretty quick, and get everybody set for what could be a surprise. And right now, if he's going to talk right now, the surprise would be he stays in the agreement. That would be a pretty bullish surprise for stocks and bearish for oil, because I think right now it's pricing in he's going to pull. It's like maybe 50-50, it seems, because the New York Times is just a source says the U.S. is preparing to reinstate all sanctions that it waived as part of the agreement. This is, again, a source from the New York Times that President Trump reportedly told France President Macron that the U.S. will withdraw. This came 38 minutes after last hour, almost 30 minutes ago. Did anybody see that? Catch it, see it, react to it, whether you caught it or not? Did you catch it or hear it in a real-time environment? Someone has to answer. All right, good. If you didn't, it's a tool missing from your toolbox. That's all I'm saying. So if you're studying to be a carpenter, you know, it's a hammer almost for carpenters, and hammers are pretty important for carpenters. So if you're continuing trying to be a trader, following news events and tape bombs or things that are driving the market is an important tool in your toolbox. And I'm not telling people who didn't see it, shame on you. I'm just telling people that if you worked for me and didn't see it, we'd have to have a discussion. So why isn't it going is the title of this week's event. Better way to look at the same thing using these edge zones. You guys could use some delta charts. You could use some different things to see it. But I didn't want to put slides together because I wanted to go to the real-time charts. And so that's what we're going to do. We're going to go right to the real-time charts and blow them up. Forget about these numbers at the bottom. Yeah, these are deltas. The top is the delta of each bar above it, and the bottom is accumulation of the delta for the entire session. But I'm not going to cover that right now. What I am going to cover is when you see a flash, and I'm going to lower something in the footprint edge zones just so we could see more examples of it, because I want to show this as it's happening instead of just images of it. We should get a lot more red and greens. Now, these are too many, right? I'm just doing this so we can get some instances under our belt. These are too many reds and greens. Let me clear some of these comments out. All right. Now, we all know, and by the way, I've been using GoToWebinar still for these weekly sessions, and I'm starting to hate it because I like that other software we use for the trading room, Zoom, a lot better. I'm sure you guys do too. At least most of you have said you do. There will be a point soon where I'll email you guys a few times, have you sign up one time on the Zoom side, and be pretty seamless after that. But I got these meetings scheduled once a week for the rest of the year, and then I send you guys an email for the next year. I might have to do that now. and then just remind everybody we'll be using that. For now, just stick with what you know. So let's go and talk about, we know that the market, first of all, moves like this, right? Rotationally. And this is a 4 PNF. So the markets are moving up and they're moving down. Whether you see that in a point and figure or you're just following it on a dome, you know that it's moving up or it's moving down. You know the direction that it's moving rotationally. And so you go and you say to yourself, if a market is supposed to move down and it doesn't, then it's bullish, at least temporarily. Now, there's been some volatility splashed back into this market with some of these headlines, okay? So stick with me on this. And there's too many instances of reds and greens, but I had to throw them up so I can give you examples. If I'm looking at the market right now, and I don't know any of this, right? I don't know any of this stuff. And the market has a red imbalance. It's very similar to how you look at the footprint filter with big orders. You're seeing an imbalance between, let me get rid of all this. From this point on, we don't know nothing. In fact, we don't know anything in here either. But all I know is that the market's moving down, okay, and a seller comes in. Not a big seller, but compared to the best bid, the best offer, diagonally, we get an imbalance. We know it's an imbalance and we know it's an imbalance with decent volume because an edge zone appeared red. It's not just a red here, it's an edge zone that formed. At that point, it should start moving down in a relatively quick fashion. It shouldn't take, if you're getting the market to step on the bids and hit them, well, then why isn't it going lower? At some point, you got to ask yourself that question. That's why it's the headline of today's meeting. Why isn't it going? Well, when do you ask yourself that question? You ask it with big buyers and sellers in the filter, but then also with these edge zones, when one appears, why isn't it going down? It should go down. Same thing on the upside. We get one right now. Why isn't it going up? And you run out of time, and you know that that's your line where if it starts going below it, it might leak lower. Now remember, I lowered the criteria of how many edge zones we get, so it's too noisy. So a lot of these aren't going to work, or I don't want to say not work, but it's you're just throwing too many instances at it, and I'm doing it so I could give you guys examples for it. But going back and say, if the market is bullish because it is green imbalance at 64.75, I don't want it to see it go below it, or I can't be as bullish as I am. I need the son of a gun to go up. Why? Because it's been given the fuel to go up. So that becomes an immediate real-time line in the sand. Does that make sense? It allows you to ask the right question at the right time. So there's right questions to ask, and most people don't know those, except you guys. And then there's the right time to ask the right question. You get too far ahead of yourself, and the teacher's going to say, sorry, Johnny, that's chapter 8. Let's wait. We're still in chapter 3, right? So there's the right question. Good question, but you're asking it before the session even started, or before we're at chapter 8 in that example. So it's the right question. Where are the big buyers or fast buyers, guys really coming in and grabbing it? And what's the reaction? What's the end result? Because what should happen is not happening, but you have to know what should happen in order to know whether or not it's happening. See, as we dip below those 64.75, what happened? The long slipped, and it's like on a rope. Your hands start to burn as you slip down. The same thing as it should have held here, and it doesn't. They jump it, and they jump it quick. But when you get the buyers that come in, and it can't get it to go up, it starts to not only get you to ask that right question, but at the right time. To say, I'm not going to stay long. Why? Because the son of a gun should be going up. I'm getting buying to come in here. And now you have a better real-time approach as to where your real-time demarcation line is. And your real-time analysis will go up. It's not going to work 100% of the time, but it's going to allow you to start to asking the right question, which everybody knows, but at the right time, which is sometimes tough, especially in real time when there's motions involved or involved. So anytime you create a better visual, you're going to create better recognition. Better visual, then you're obviously going to recognize it better. There's a better visual. The market had to go down. Now see the difference here. Let me throw this up here. Do you see the difference when this imbalance came in? What happened? It immediately went up. Well, this was supposed to happen. Now it should be support because it went up 1, 2, 3, 4, 5, 6 ticks. That's a healthy pop, right? 4 to 6 ticks should be support. If it's not, then this is just a crap read. Not on your part, it's just the market's crap right now. Overall, it's got a cloud because of this announcement that we're waiting for in a couple hours. So it's kind of tilting to the downside. But yeah, there should be support at 64 even. If I see some red come in and they can't go low, maybe that's your qualifier to buy support. And you don't have to get run over by a train until you see that instance. Or maybe it's something else. So here's the red coming in. And again, remember, these aren't, I want to say real edge zones, but there's way too many of them based on the criteria I lowered or adjusted. So you see that red came in. I got to get rid of this illustration. And it couldn't go lower. Where do you come in at? And then they took them away. They should have whacked them. As soon as they got above them, they slid up. Maybe it qualifies your support a little faster. Macron just said Trump didn't indicate what decision on the Iran agreement during the earlier phone call. Fake news by the New York Times. Thanks, Carol. My screen on a different PC went black. Well, no, I mean, it went to sleep. That's why the Trade the News, I didn't see it, but Carol's watching it. So, Carl, good job. And that came out a couple minutes ago. Just like I said could come out. They dispel it. French president, spokesperson, Macaroni said Trump didn't indicate any decision on the Iran agreement during the call this morning. So they had a call, but that wasn't the case. So we go, you got to follow this story here. We open up our eyes this morning that there's a likelihood he's going to pull out of the agreement. Oil's bullish. We're kind of bearish. Late yesterday and into today. 11 minutes after 10 Central. Oh, he's going to stay in the agreement. Oil goes down. Stocks eventually go up. New York Times reports that Trump in the call with Macron said, going to pull it out. We go down. Oil goes up. This latest dispels that and puts us back to possibly where we were this morning before the press speculation, because I think that's all it was. It was press speculation. The first report at 10 minutes after 10 this morning, at 38 minutes after 10, more nonsense, New York Times. And now I think this is more solid indication that he didn't indicate to Macron what he's going to do. And so the market goes back to probably thinking 50-50 or a little bit better chance he's going to pull out. Still more breadcrumbs to follow, possibly before the 1 o'clock Central press conference he has. Going back to this, what did we see? After it's almost like the hand comes in, like a hand comes in right here, and should push the market down because a red edge zone appeared, and then all of a sudden the hand let go and it was able to pop. Does that make sense? Is that a good way to explain it? Now, these disappear, so you can't necessarily go back and say, it worked, didn't work, because sometimes the red shows up because it meets the criteria, but then fades away because it didn't before the bar is finished. So just remember that when you're going back to look. So now let's take this to better criteria, because these edge zones would be just too noisy if you couldn't adjust them. I'm telling you that right now. You have to be able to adjust them. If not, then you're just, it's like good music that isn't in sync. It's like good instruments and a bad singer. So to me, take a look at this. This one does stick, right? And then they slide through it. Do you think that that's a coincidence? Like, it should not get below this guy, and if it does, it's gone. And then wham, it gets released. Make sense? This guy came in at the bottom of this bar, popped it, so they should hold it. And they do. Because he actually got it to go 6 ticks. So they should hold it when it goes, in my opinion, 4 to 7, not 4 to 7, 4 to 8, 1 or 2 points. Then it should be subsequent support. All right, here. So a red guy comes in. They jump on the 63 evens, sell it, hit it good. So if it's going to go down, this son of a gun should start going down now. Goes down 4 or 6 ticks, and okay, it did what it's supposed to do. If it didn't go down, it's like, what the hell can it go down for, right? And then you'd be worried about being short. Did what it was supposed to there. Is this helpful? Does this make you, scratch your head at the right time? It's just a way to increase your real-time skill a little bit better. Give me 1 second. All right, I'm back. So should it hold below here? And it does one time. It should hold below there again. And if it doesn't, you start to become less bearish. I want you guys to read this. Nobody answered me. Does this make sense? Doesn't have to make sense. You could say, no, I don't think this will help, and that's fine. But you got to recognize. I want people to start recognizing it. If you don't have edge zones, then use delta charts, right? Where you see the delta spike lower, because it's going to tell you the same thing, like real-time delta. If you see, the doctor said yes. He's the only one that says yes. If you see the delta on a chart go down, all right? If you're charting, let's just forget about all the footprint numbers. Just pretend the yellow line is the delta, and you see it do that. Well, then price should go lower. If it's not, it's absorbing all of this selling. There's another thing I wanted to cover today, and that is wait a second. It's important, but I forgot it. I don't know if this is what it is. It's not. It's something else. It'll come to me. I wrote it down somewhere. I can't find it. But the delta, like I said, on a delta line chart, if you see a spike in delta and prices isn't going up, that means, oh, what's wrong? It's being absorbed. That's what's wrong. And down here at the bottom, like I said, the top line is the delta for that bar. That's going to tell you accumulation of every price in that bar instead of that one particular relationship between the best bid and the best offer, because the edge zones are always telling you the difference between the best bid, best offer in any one point, because it's diagonal, the relationship, right? And so right now, if you got a big jump in delta, you should also have a same time jump in price. Macaroni. Oh, that's what I wanted to say. Perfect, because it happened today, and I need people to make sure that they're catching trades like this, or at least timing their thought process. I'm going to pull up a chart of the ES, and this happened today, and we're going to make this a 1 minute chart, and we're going to take this and we're going to make the where the heck is it now? Oh, it's all in here. Instead of that, let's go take that out, make that a 60 again, and we'll take this guy. This is a chart comparing the E-minis to the Dow. They look the same, right? They're supposed to. They're both stock indexes, right? Right. So now let's change one of them to crude oil. Crude oil is in red, and the Dow is in, not the Dow. Yeah, it would be the Dow. Actually, let's make the Dow the ES. Okay, that's what it is now. And why isn't it this decoupling? Hold on 1 second. I think we're going to be able to see it either way. Hold on here. There we go. There we go. There we go. All right. This morning, I would say right on that 10 minutes after 10 Central moment, Iran Parliament just sent a letter to the president that Iran's rights should not be trampled by Trump if he denies the agreement. In red was that big sell-off we had after 10 Central that he was going to stay in the agreement, just increase sanctions. Oil said, well, there ain't going to be a supply shock. We could go down. We went down with it because of how the energy, the oil markets affect the energy sector, which is a big component of the S&P. So we initially went down with it from like 70 to 62, 63. And I remember 62.75 was a price that we were trading. And I got to put a highlight on it. It was right here. No, it was actually all in here. And I'm going to show you why. Okay. Now you see this inside that highlight? Now oil comes down all the way from up there, shoots all the way down to here. Okay. S&Ps go down with it. Now let me get rid of these drawings a second. So the S&Ps go down with it. Oil, and I remember the price, was at 68.25. And they didn't just hit it, they stampeded through 20, 15, 10, 68 even, at 95, at 90. And the S&Ps, all we did was flicker. 62 quarter, 62.75, 62 half, 62.75. They ran oil 70 cents lower. Remember that? 70 cents in one, and from just here to here was a 70 cent break. And we couldn't, this first 70 cents, we went down a lot. But they just slammed it 70 cents and we couldn't really budge. Couple ticks back, couple ticks back. And that's when I had said, you got to be careful short, because if they turn this thing and come screaming out of the hole, which they did right here. See, this is why I like the other software. It came screaming out of the hole right here in red. And we jumped in the ES. You guys remember that in the room this morning? It wasn't that long. It was about an hour ago. We were going down with oil, going down with oil, going down with oil. Oil continued to go down, 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 and we stopped following it. Let me draw it like this. Forget about all these other illustrations or lines. Forget about the chart. Just look at this. We go down. It goes down. It goes down more. This will go down with it. It goes down more, and this doesn't. Just collects itself. It's like, man, it should be down here based on what the relationship was. And then wham, this fires out of the hole. Wham, this really fires out of the hole. If you were bullish and that recognition between two markets that were relating was starting to tell you what should happen isn't. But if you don't know what should happen, then you're not going to be able to answer the question that what should happen isn't. And what should have happened at 62 quarter, 62.75 in the S&P when oil breaks another 70 cents is we should have broke 2, 3, 4 points with it, because we had been breaking that all along. It didn't. As soon as oil rallied out of the hole, S&Ps rallied 14 points. Was it time to get out of a short if you were short, get long if you were bullish, or both? I want people to get better at that because it's a way to use relationships. There's not always a lead lag, but then there's a lag because the leader isn't, if there's not a leader moving together, and then all of a sudden they're not moving together. That's a scratch your head moment. Let's get rid of that. Go back to the chart. Right now, just real-time analysis, there's sell stops below 60, 62. Obviously, this market is waiting and starting to lean on the side that maybe he's pulling out of the agreement. Maybe not as probable as this morning because of some of these news events that have popped down the wire. He's going to do it. He's not going to do it. Macron, he said yes. Macaroni says no, he didn't. Here's another example. Some big sellers aggressively come in at 63.50. They throw in an edge zone. It should go down, and it does. Now they should hold 63.5 as overhead resistance if they're going to take out these sell stops. You shouldn't stay too bearish above 63.5. Real-time analysis. Because it, in a timely fashion, should go down when you see a red edge zone light up, especially if you got your volume criteria set properly. One Central, that's 1.5 hours from now. It could come out before or after that. I don't know if it's a press conference. I don't know right now if it's Q&A. Find that out. But I'll jump in the team room. For you guys that come every week, jump in the trading room. You're missing a lot of good stuff day in and day out. But as far as this session goes, we'll let you guys back to your workstation. You know what to look for. You know what could happen before that. Keep an eye on what should happen, and then ask, is it happening? But you got to know what should happen. Relationships and aggressive selling and buying. We'll see you guys tomorrow or next week.